and welcome to Hot Money on BloombergQuint Live, India's first digital live streaming business news service. This is the show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our experts and Vineeta Sharma of Narnolia Financial Services, Senthil Manikandan of Newberry Capital, and independent investment advisor Vivek Mawani joined me on the show. Thank you to all for joining me on the show. Today on Hot Money, we'll discuss stocks like Piramal Enterprises, we'll discuss the cement pact, we'll discuss Britannia, and we'll discuss NIIT Tech. So that's what's been spoken about in the show today. The first stock that we want to talk about is Piramal Enterprises. Stock almost at levels of 1900. Remember, at the peak, it was trading at levels of 3500. So almost close to half of what it was. So is it a good time to start accumulating Piramal Enterprises? They've given a lot of clarifications that, you know, some of the developers where their name was associated with, they don't have an exposure, but some of the ones like, you know, like a Lodha, where they do have an exposure, there is no default or a delay in payment of the term. But what should one do with Piramal Enterprises, and what's the way ahead? We'll ask our guests. So Vivek, I'll start with you. At 3500, everyone wanted to buy Piramal. At 1900, it's fallen like a pack of cards. So what should one do now?
Well, very interesting remark that you made. At 3,500, everybody wanted to buy, and 1,900, it's probably become an untouchable. Well, that's true for markets. I mean, just 2 months ago at 11,700 Nifty, everybody was gung-ho on Nifty. Today at 10,300, everybody seems to be giving targets of 10,000 or lower. So that's the nature of the market. Coming to Piramal specific, as I have mentioned, and I will repeat that for Piramal, I have mentioned that for India Bulls and Diwan Housing and other NBFCs in the last few weeks, there never is smoke without fire, number one. Number two, so even in Piramal, I mean, almost a 40% or a 35% decline in stock price in the last last few weeks cannot be without a reason. The management may give clarifications, and it seems to be a season of clarifications from a lot of companies in the BFSI space saying, hey, no, we are not affected. It's like saying if it's raining outside, you can't say, no, everybody will get wet, but I'll stay dry. It doesn't work that way, number one. Number two, Piramal has built a fantastic business. I use the word fantastic business, and built a strong niche in real estate financing, where they are probably very good at structuring deals. But all of us know real estate is a stressed sector for the last several years. New project launches have come down to a trickle. Sales have been slow, and inventories of finished apartments and commercial real estate have been piling up to the extent of few million square feet across the board, whether whichever city that we are talking about. So Piramal, which has lent to real estate sector, and the majority of the NBFC book is in the real estate space, then one is at pains to understand to whom have they lent, that they don't feel the stress which everybody else feels the stress. Real estate developers themselves feel the stress, but Piramal doesn't. Then I would like to understand that business better. So clarification is welcome, but it leaves lot more questions unanswered, which I'm sure the market will look at answers. And if those answers are not forthcoming clearly, the stock price derating in terms of contraction of multiples will continue in the next few months. Having said that, even if one were to look at, I mean, okay, NBFC is just about 50% of the business. The other 50% is pharma and their healthcare analytics business, which is about 8-10%. I have maintained in the past also, medium to long term, the key trigger is value unlocking and demerger of the finance and the financial services and the pharma and the healthcare business. So whether it's a demerger into 2 companies or 3 companies, but that is the key trigger. At about 14-15% return on equity on a consolidated basis, I mean, even today it trades at about 1.5 times price to book, which isn't really a great valuation when you look at some of the other, I would say, private sector banks, which seem to be doing much better. Some of the other NBFCs, which relatively will be less hurt from the real estate and other stresses in the economy. So I would give Piramal Enterprise a miss at this point of time.
Okay, it's a miss from Vivek. What about you, Vineeta? You'll have coverage on Piramal Enterprises?
We do not have active coverage of the company, but still as it is in the NBFC and pharma space, it is a well-tracked stock. And regarding Piramal, the management soundness in terms of ROE or return on asset has been phenomenal. The growth has been phenomenal over quite number of years, and they are the ones who have incubated a company and gone into real estate, and they have done phenomenally well. But the near-term headwind on the basis of liquidity crisis or the asset liability management, these are the things that are weighing on the company, and will certainly weigh, because it will in the near term, it's the net interest margins. If you just consider the P&L and the balance sheet, the net interest margins will be deteriorating from here on. As well as there has, as Vivek pointed out, that till date none of the companies have defaulted, but still the kind of scenario that is getting built, and this liquidity issue might get a little worsen, though as of now things are still better. But still, I believe that as of now, we should be avoiding this company. Still, if somebody wants to have it on their portfolio, and because of the management soundness in terms of the assets, return on equity and assets that they have maintained, we can have a target of 2,900, but then I would not say immediately to jump into the company and have it.
Staggered buying?
Yeah, staggered buying in the company.
Okay, staggered buying avoid by Vivek. Senthil, what's your view on Piramal Enterprises?
So like they say, good news and good prices don't come together. I think the crisis in the NBFC, especially in the housing finance space, I think has resulted in a substantial decline in the stock price of Piramal too. So if you look at Piramal, the last 6-7 years, since starting their financial business from the scratch, they have built up a loan book of close to around 40,000-50,000 crores. And especially in the, if you look at the product categories, they started with just mezzanine lending to the real estate space. Now they have close to around 22 products, and they have ventured into the corporate finance lending also. So I think now they have diversified lending portfolio, and of course around 50-60% comes from the construction lending space. But I think the last analyst meet which they have conducted in August, the management focus has been more on the risk, process and control, and their lending is majorly towards developers who are like established houses. And I think the management's quality over the last 30 years, like what of the dividend payout and the kind of, they focus much on the ROE and the profitability much more than the revenue growth. So considering all this, I think the current crisis offers a good opportunity to enter into the space. I think it's accumulate on decline.
So I think that's the view that's coming in on Piramal Enterprises at this point of time. Vivek would avoid the counter, but the other two guests believe that it's an accumulate on decline. So they're also not seeing any kind of heavy pullback that will come in on Piramal Enterprises, but it's more accumulate at this point of time. The next stock or sector that we want to talk about is the cement sector. Now, ACC disappointed with earnings. UltraTech also disappointed with earnings, and a whole host of companies will come out. Most of these counters are trading near 52-week low or or at the 52-week low. The commentary from UltraTech was not the best. The commentary from ACC also not the best. So there is enough pain that's happening on the cement pack. But what's happening? Is there a more potential weakness coming in from the cement sector, or would you venture a guess and because of the valuation accumulate some of the cement stock? That's what we are asking. So Vineeta, your view on the cement space at this point of time, what should one do?
So we have been neutral on the space as such, and if we consider the EV per ton for all the cement companies, certainly they are at historical lows and they look attractive. But if we compare the EV upon EBITDA, UltraTech still is not pretty cheap in terms of EV upon EBITDA, or most of the cement companies, they are not very lucrative in terms of that valuation. Now, earlier if we see the kind of the capacity in 2013-14, the kind of capacity built up was there in most of the cement companies. So there was a belief that the demand will follow. And till date, we have not seen any kind of volume growth, organic volume growth in any of these companies. So inorganically, they have acquired companies and the volumes have gone up, but nothing much on the demand side. Even considering the recent quarter results, So monsoons has played an important role. Demand has been slow. Even on the infrastructure space, we are not finding the demand to turn up very recent future. So that's on the demand side. And margins, like everybody knows, the petcoke prices or the freight costs, they have inched upwards, and that is having a way on the margin front. So overall, I would wait for some more, 1-2 more quarters till I would see some kind of demand revival. And only when the capacity, the demand supply situation is such that it augurs for a realization uptrend. So now only also realizations have not moved up. I mean, because there are a lot of capacity vacant with the companies, so that doesn't call for that. So only once the demand moves up, and that will need to wait and watch. So UltraTech has been very positive on that sense, but then they have said that it should be after FY 19 end only, I think, or 20 in fact, when the leverage will also go down, all the capacities would start paying. So I think we should wait more.
So among your coverage, which is the best cement play and which is the worst cement play?
So amongst our coverage, we are almost neutral on, there are 4 companies that we are covering, and neutral on most of even. So even if only UltraTech we are little positive, being a large cap, considering the current situations, none of the mid caps we are asking our investors. So somebody wants to have a cement, so they can have UltraTech.
Okay, what about you, Senthil? Your view on the cement pack?
So basically, cement being commodity, it is driven by the demand supply, how the demand supply goes on. So now if you see in the last 3-4 years, much of the demand comes from the infra play. So infra has been the only segment which has been growing in double digits, while the residential plus commercial has been going in single digits, and it's been tepid. So on the supply side, if you look in the last 4-5 years, there has been a lot of consolidation happened in the market. And now the top 4-5 players have a nearly 50% both in the production and capacity market share. UltraTech alone has around 25% market share across India. So with this consolidation in the top 4-5 players, I think the pricing power would come in even when the demand grows. But demand has been slack. So we have to wait out for a demand uptick in the market. And we have to go for the large players like UltraTech, Shree and Dalmia Bharat. So those are proven execution track record. Plus, like Vineeta mentioned, the petcoke prices has been up nearly 30% year over year. And if you look at all these players, last 3-4 years, they have went in for a petcoke because it was lower compared to the coal. So now they are facing pressures because of petcoke, and they are just looking to move away to petcoke or some imported coal like that. So we have to wait out how these companies are passing on these cost increases. So I could prefer the large players in the pack, and I could at present I'm neutral on the stocks.
Okay, so that's the view. Prefer the large caps, and that's something even that Vineeta spoke about. UltraTech is something that we prefer. And what about you? What do you make of the entire scene, Vivek?
Well, I think this sector is also, barring couple of companies, is an avoid for 2 reasons. Industry capacity utilization is still sub 75%, and the return of pricing power, I mean, see, finally commodity profitability is driven by higher prices. Volume being growing at about, I mean, one can assume 7-8% normalized long-term volume growth as far as the cement is concerned, is the price growth which contributes to the uptick in profitability for cement companies. And as far as price realizations are concerned, they continue to be under pressure, in the sense none of the cement companies really have that pricing power, because industry capacity utilization is just about 75%, give or take couple of percentage points. In case of some of the larger companies, probably it's slightly higher, but the cost push is certainly denting their ability to improve margins. And when we look at valuations, none of them really look cheap given the headwinds on profitability. As far as the demand side is concerned, in an election year, of course, infrastructure always is a key driver, but the larger driver, which is real estate, is in a subdued territory in terms of, as mentioned earlier, new project launches from real estate is down to a trickle, and the huge pile-up of unsold inventory in real estate. So real estate is not really going to be contributing to demand growth as far as cement is concerned. Valuation-wise, none of them really look particularly cheap. The only one, or rather only two companies that I may look at is Dalmia Bharat, where they have very steadily expanded and a very strong player in South India and East India. East India now probably they will be the largest post the OCL consolidation and all that. And in terms of cost structure and the pricing that they get in their key markets, I mean, it's got the highest profitability. I mean, 1,000 rupees per ton of EBITDA is the highest in the sector, I mean, among the cement companies. ACC and UltraTech are just too far away. I mean, they're at least 30-40% lower in terms of profitability compared to Dalmia. So long as the pricing headwinds continue, I'll stay negative on the sector, and I don't find opportunities barring continuing to hold on to Dalmia Bharat.
Okay, so that's the view that's coming in on cement sector. I think it's a cautious view coming all across, but it seems that the trend is towards the larger caps, like your UltraTechs and the Dalmia Bharat, rather than pick anything on the smaller side of the cement end. The next stock we want to talk about is Britannia. Now, Britannia has also corrected significantly. Valuations, no doubt, have come down, but from all the way from levels in excess of 7,000, it's now at 5,500. Valuation, something that now will find favor with the street, or is still there potential downside, or would you avoid Britannia? So, Senthil, your view on Britannia, valuations now attractive after this 20% fall that we've seen?
So within the FMCG pack, we like Britannia and Nestle, basically because their major focus on the packaged foods category. So if you look at the India's per capita GDP, it's below $2,000. So if you look at the history of China or other developing and developed markets, whenever the per capita GDP crosses $2,000, there is a disproportional increase in the discretionary spending. So with this, I think those guys who are present in the packaged food category should grow faster than the likes of HUL, those are majorly into personal and home care segment. So within Britannia, if you look at 70% comes from the biscuits part and 30% comes from the cakes and breads, etc. I think management focus on driving the premium category biscuits. And now their market share is around 35%. They are looking to increase to 50%. Is good both on the margin level. But because if revenue grows at a range of 10-12%, I think the PAT will grow at a much higher pace of around 20%. So I think business-wise we like the company, but valuation-wise I think it's still trading above this 5-year average PE.
Yeah.
So I think we could wait out and to arrive at a better reasonable valuations.
Okay, Vivek, Britannia valuations reasonable or is it expensive?
Well, it certainly is expensive at about 60 times current year earnings. It's, I mean, certainly not cheap. Last 2 years, Britannia has had a stellar run, both from the business point of view as well as from the stock price point of view, which led where the multiples have expanded massively. But of course, last 2 years was also, I mean, the Britannia also saw fairly sharp increase in margins and an uptick in growth rate where they gained significant market share from the other major player in the biscuit segment, which is Parle. Now, over a period of next few years, Britannia intends to diversify the revenue streams and have a larger contribution from dairy, which is going to be more of value-added products in dairy, which is your cheese, butter, yogurt, and maybe some other similar products. Now that also is a very crowded space, and relative to biscuits and other categories, similar categories that bread and rusk and cakes that Britannia is present in, dairy actually is a relatively lower margin business when we look at the other organized or branded dairy companies that have been listed for a while now. So whether we look at a Hatson or a Prabhat Dairy or Govardhan and so on and so forth. Govardhan is actually the Parag Milk, sorry, I was referring to the brand and the company. None of them really have margins which are in double digit, which in case of Britannia, the biscuits and the bakery business gives it. So going forward, how is the margin going to continue to expand remains a question mark. So in best case scenario, margins will be steady state at these levels. Worst case, with maybe commodity price inflation, especially on agricultural commodities, because in case of Britannia, all the raw materials are agricultural outputs, and any inflation on that side is going to be hurting them on margins. So although I'm positive, I mean, I will agree with Senthil, business is good, valuations are not so good. So at comparable or similar valuations, I would prefer a Nestle, which has significantly more pricing power for its products, or within the consumer space, whether it's a Titan or a ITC. ITC is also a preferred play for me. So I would give Britannia a miss at this point of time.
Okay, so that's the second view coming in on Britannia. Before I go to Vineeta, I just wanted to highlight Britannia FY19 PE is at 55 times. The peak forward PE was 70 times, and the 5-year average is at 38 times. So still much above the 5-year average. Vineeta, what do you make of Britannia? What are you advising clients?
So Britannia, we are positive on the company and the kind of consumption space that it is catering to. So that's a positive on the business. Also on the valuation, if we look, we have seen the 5-year average, definitely it's trading around on the higher side. But if you look at the immediate 3-year term, it is around 44 times FY20, and the 3-year average will come around 52. So for me, I think valuation comfort, not very comfortable, but it's not very demanding. I think it's pretty comfortable. 2 points that I wanted to highlight here is, one is Britannia has already done the margin part for from 2007, from 6% margin to now 15% margin. Britannia has come over, and this was primarily because of the supply chain and the distribution channel that the company has worked on under Varun Berry. So now the next leg of premiumization, if we consider Nestle, the EBITDA margin is around 21%. For Britannia, it's still 15%. So premiumization has not played as such. Now, whether it will be able to cash in on that benefit, because if we look at Parle is also doing equal amount of efforts on bringing up the products, the kind of ad spends that they are doing, and if we consider, so premiumization should play on little bit from here on, considering some 50 new products that company is planning right now. Also, but the ad spend for Britannia also should move up.
Okay.
And considering on the raw material side, so as Vivek pointed out, so wheat and all these costs have gone up, though they are covered till January 2018, that's what 2019, they are covered till there. But still, because of higher MSPs, the cost will be elevated. So now it will be very important how like in 2007, how the management behaved was very important, and that took the margins from 7 to 15. Now again, it's time for how the management reacts and how the strategy plays out for this margin to inch upwards towards Nestle.
Okay.
So I think Britannia is positive from our side. We have around 6,600 target for Britannia, considering 52 times FY20 price to earnings.
Okay, so that's the view that's coming in on Britannia. More of a wait and watch approach, while two of our guys do believe that Nestle is a better pick. We just have time to take initial comments on NIT Tech. We have almost run out of time. NIT Tech has outperformed the mid-cap IT space. It's doing well in today's trade also. Numbers were good. What's the view? Vivek, this had to go fast. NIT Tech, will the rally continue?
Well, my sense is yes. I mean, within the IT pack, this seems to be relatively a safer bet, where the management is clearly guided for accelerated growth backed by strong order wins that they have and expansion of margin. So the 18% EBITDA margin, the management that they have done in the recent quarter, management says this is now the normalized margin. So going forward, what we will see is continued double-digit top-line growth and margin expansion, leading to a sharp improvement in earnings, and at about 15 times 1 year forward, at about 19 times current year earnings, it is still relatively a discount to some of the other mid-cap IT as well as the large-cap IT, and this seems to be, from the margin point of view, not necessarily moving closer, but still improving on margins, which very few Indian companies seem to be doing. So I'm positive on NIIT Technology.
Okay, Vineeta, NIIT
So
Tech.
NIIT Tech, it's like good fundamentals but good valuations also. Considering the other peers in the mid cap and the lower mid cap space, NIIT Tech has, given good results, and the management is also very confident of taking good deals going forward. And so overall, I feel the fundamentals are good, and so are the valuations. So one thing is that how the valuations, whether, because in the past we have seen volatility in the earnings of NIIT Tech. So but yeah, there are changes from the CEO from top. Also, in the entire structure of NIIT Tech, there has been a lot of new additions on the top level. So I think let's hope for the best. If 18% EBITDA margin is sustained going forward, it should continue outperforming.
Okay, and Senthil, your view on NIIT Tech?
So among the mid-tier IT companies, those who declare results for Q2, I think NIIT Tech has outperformed its peers. Just quarter-over-quarter dollar revenue growth of nearly 5.8% is on the higher end. And if you look at the deal wins also, it has been consistently increasing in the last 6-7 quarters. Currently their order book also, it's up 30% year over year. So I think the management guidance of 15% on a constant currency terms revenue growth plus their margin guidance of 18% is also looks attractive in the mid-tier IT pack. So we have seen the likes of Persistence and Mindtree. After the results, their stocks have crashed nearly 17-80% because their valuations was not in line with the business. I think if you look at the NIIT, I think the valuations are comfortable considering the revenue and the margins they have guided. I think 1 year forward, 13-14 times for a business that has an ROE and about 20%. I think a free cash flow generating business, I think it's looked attractive in the mid-tier pack.
Okay, so that's the view that's coming in on NIIT Tech. I think but the consistent view or the consensus view that we're getting in on NIIT Tech is the fact that valuations are pretty much in favor, and probably that could continue. But with that, we have completely timed out on today's Hot Money. Vivek, Vineeta and Senthil, thank you so much for joining me on the studio today. Ask BQ comes up next. Stay tuned to BloombergQuint.